Recently, Sweeny has talked about Crocs. One photo actually caused Crocs to go up, as you can see here, last Friday, 6.63% on the day, just from posting an ad with the Hey Dude moccasins or whatever on her feet. And actually, when you dig a little deeper, Crocs is actually a decently good business, and that's what I'm going to tell you about today in this video, and why it's also an interesting technical setup. Now, personally, full transparency, I am long Crocs right now, around the 77-ish area. On Friday, I opened and I initiated a new long after the Sweeny ad dropped, because she's basically a better trader than Nancy Pelosi right now. And that's something you should keep an eye on. But again, that's kind of a meme reason. Let me give you the real reasons, and we're going to look at the chart on Crocs and why you may want to consider why it could be something to add to your current portfolio from a risk standpoint. But first, let's get into the nitty gritty with what Crocs is doing right now that's really good from a fundamental point of view. Obviously, the first thing is that they have a strong brand appeal and a very loyal following. Mostly everyone has a pair of Crocs in their home. I personally don't, but my wife wears them. But I don't own a pair, but a lot of people have a pair of Crocs. They have a very unique product, very unique identity associated with them, and that in itself has its weight in gold. If you've watched my show or you watch my channel or any of my YouTube videos, I really love when very recognizable brands are beaten down on the chart. Specifically, they've lost value for whatever reason, but they hold really good brand recognition, because that in itself has a lot of value that's intangible, right? But not only do they have a good brand, but they have a really good business in general. They really run high margins right now, and they have a profitable track record in general. So they've been generating for the last few quarters pretty healthy operating margins versus their peers. And a lot of this information I'm going to give you guys is comparison for them to their peers. So people in the appeal industry, garments, etc., how Crocs compares to them. They actually have a really solid opportunity I don't think a lot of people are looking at for Crocs and their other brands with their international growth. So there's an opportunity there because they have a very low market share in Europe, in China, in India, and these are massive markets where they could actually expand and sell more product in. And they have fantastic margins. So even if it's a matter of selling these products cheaper in these areas to serve more impoverished communities, i.e. like India, when there's a lot of people and they may not have as much money, they could still make a great profit because they can actually take a smaller cut and sell higher volume. So there's a great opportunity there, I think, for the international growth of Crocs. They've also shown lots of love for their shareholders by repurchasing shares over and over and over. They've continuously increased buyback authorization, and they're willing to return more capital to the shareholders, reward the shareholders by not diluting their stock, which is a fantastic thing if you are a shareholder of Crocs. The last thing I want to highlight before going into the fundamental reasons why I like Crocs, they're very resilient under this macro stress. So obviously we have tariffs and everything going around. There's a lot of consumer headwinds and whatnot. And their management is actually doing a really solid job with cost control. They're keeping their brand strong, and their balance sheet, they're not letting it get out of whack with everything that's going on in the world, which I think is a very underrated edge that they have versus their competitors, where especially in the environment they operate in with appeal, with consumer products, right? Because it's not a staple, it's not something you need, but it's a consumer product that people may want. Having that edge of having fantastic management with great margins is a really, really solid thing. Now, talking about their great margins, we're going to talk about some of their financial, some of the more fundamental things that makes Crocs a very interesting setup. And then we're going to look at the technicals. We're going to look at the chart right now. And even though the technicals aren't fantastic, why it's a really good risk to return opportunity right now, where it's currently setting even after Friday's move. Now, currently, and I've got few points here. Then I'm going to dive into two specific points on why their fundamentals are pretty solid. As I alluded to, they have very solid margins right now. So currently they're at roughly around a 24% operating margin, which puts them ahead of basically all of their peers. 98% of their industry peers, they are operating margins that are insane in comparison to all of their competition, which is fantastic, which arguably isn't really confusing considering they're just selling like foam on your feet. I'm sure cost is not very high, obviously the labor and everything, but makes a lot of sense, and their margins prove that, right? They continue to have that gross margin strength because they've currently reported around about 59.3%, which is demonstrating that they have a lot of strength over their pricing and the control over their cost of goods sold in different markets everywhere. So they have that control over those margins to continue to understand where they can take a little bit more money and where they can shrink that area and find new opportunities, as I alluded to previously when I was talking about that India opportunity, right? Recently, you've seen their revenue grow pretty steadily, honestly. 3.4% in Q2 over the last year over year, and generating about $1.15 billion, which met market expectations in Q2. So they're at least meeting expectations, even though, as you can see on my chart here, didn't look like they were. But is that just fear? We'll talk about that in a minute. And lastly, I wanted to say how management has been talking on their conference call. So I went back and actually listened to a few of their conference calls, and they are really emphasizing reducing inventory and cutting expenses and really trying to push that margin profile, that edge that they have really, which is a strong margin, even further to drive more net income and drive an expansion of the margin to even make even more money on their already large margins. So by controlling that cost of goods sold, controlling how they're making their money, whether it's through labor and their general inventory as well, not carrying so much inventory, is a way that they're trying to move a little bit lighter and still generate a lot of money. Speaking about money, I ran a few formulas here to kind of get an idea, and then I compared them to the industry peers. So I ran forward PE, ROIC, their EV versus their EBITDA, and their EV versus their free cash flow to kind of give an idea of how they're performing financially. So their forward PE currently is around 7.3, and the industry average right now is around 13.4. So basically half as much, or half in comparison to the rest of their industry peers. Now, when we look at ROIC, which is the return on investment capital, they are double the industry standard. So they're showing that they're efficiently deploying the capital that investors are giving them, essentially. Industry average is right around 8%, and they're over 20. So they're taking the money, and this is a rolling 3-year average. They're taking the money that people are giving them, and they're able to do more things with it versus their peers. Not that their peers are bad, but they're doing twice as much theoretically than their peers. I do want to hone in on their their enterprise value versus EBITDA. I can never say that. EBITDA, EBITDA, and their enterprise value versus their free cash flow. So their EV versus their EBITDA is 5.3. The industry standard right now is, or I should say the industry average, is about 10. And their EV versus their free cash flow is 7.5, while the industry average is about 15. So to explain a little further, the purpose of how EV and EBITDA affects this company specifically, or all companies, it shows how the company is valued relative to its operating cash flow. And this is before financing and accounting expenses. That's what your EBITDA is, right? So in this case, a lower number can signal that it is undervalued versus its peers. So it's a good way to compare things across industries or with their other peers. So again, the number that we get for Crocs is 5.3, and the industry is about 10 to 12. 10 on the low end. I like to use the low end, so it's twice as well. So I guess if you want to put it in layman's terms, think of your enterprise value versus your EBITDA as how many dollars investors are willing to pay for each dollar of core operating cash, again, before expenses, accounting, and whatnot. But to go a little deeper, let's use the same enterprise value and compare it to cash flow, or free cash flow, I should say, to get an idea of how they compare to their peers as well. So for that, what this does essentially is to measure how expensive a company is relative to the actual cash it generates after their expenditures, after capital investments. So the use case for this primarily is favored by people who are like more long-term investors, which is kind of what I'm looking at here as an opportunity for Crocs, mainly trading equity on this name. Because free cash flow at the end of the day is what's going to be left to pay their debts, right? It's going to be left to buy back shares, as we talked about, as they've been doing, or pay dividends, basically things that would benefit you as the shareholder. The more free cash flow a company has, the better, right? So essentially you want to think of it as how many dollars are investors willing to pay for each dollar of real spendable cash that the business can produce. So after everything's paid off, how much money am I going to get back as an investor theoretically in comparison to their peers? So if you want to compare the two a little closer, because both are ways to understand evaluation of a company, your enterprise value versus EBITDA is a way to look at operating performance before your non-cash expenses, and your enterprise value versus free cash flow is a way to look at the actual cash that's left in hand after running and maintaining the business, paying any expenses, etc. So all of these key financial metrics that you want to look at, and you can dig into specific things if you like, but running these are just a few of these ratios you can run to kind of get an idea of how a company compares to their peers. And because of these ratios, because of their current performance, I think from a fundamental standpoint, Crocs is actually sitting at a fantastic fundamental point of view. Now, roll that all into the technicals, right? What I master, what I'm proud of, what I do every single day is look at a chart for its technical basis. And on the daily chart, it's not fantastic, but it's not awful either. Now, on the daily chart, we recently had a new 52-week low at the beginning of August at 73.76. Recently, before that Sydney Sweeny catalyst, I should call it, last Friday, we got pretty low there. Recent low was 75.28, and then you had another low here at 75.74. So we're seeing some bulls step in above that 52-week low around that $75 range. Now, I'll remind you, full transparency, I am long around $77. So looking at the setup right here from a technical basis, it is not out of the woods by any means, right? This is not a clean chart to trade to the upside by any means, but it could show the early signs of a reversal here. You are making a higher low on the daily chart. You did have this big volume candle here on Friday, and you moved right up to my first price target here of 81.69. Currently we're beneath it, but we did move all the way up to my first price target in one day from my entry to this 81.69. That puts you in this earnings gap, which we do have other price targets we're going to look at in the earnings gap, but that does put you in this earnings gap from August as well. Looking at the weekly, again, not fantastic look here. You are below all your EMAs, all your MAs, but you are maintaining a higher low. So if there was an opportunity on higher volume, which we're seeing here on the week, look at the last 2 weeks, even the last 3 weeks, volume has been slowly ticking up. There could be an opportunity here for a reversal to the upside, and if it is, it would be right around now. Looking at the monthly as well, this is why I'm going to highlight this is a good risk to reward setup. You are at a low, a multi-month low here, even though we're at the 52-week low. But in this general area down here around the $77 area, you're seeing a lot of basically momentum to the upside, with the exception of obviously where we broke here. But on this level, the reaction above this level tends to be fairly bullish. And when we react to this level, you can even use this one right here on November of 2023, wicked beneath it, shot right back up. This is a very, very key area of liquidity on this chart for Crocs. I also want to highlight to you guys the volume on the month. Look at last month's volume candle here. Now, again, it was a big dump, right, because we had that sell-off, but look at the wick that we're seeing on the monthly here. A big wick to the upside, indicating that people are buying the dip, theoretically, on Crocs. And now we're seeing a little bit of a slowdown here. Again, so far, the month ends tomorrow, technically, but we are making a higher low on the monthly candles, and assuming Crocs doesn't totally tank between today and tomorrow, then we will create another potential reversal candle here on the monthly on Crocs. Now, again, as I said, this isn't a perfect technical setup, but because of everything I just alluded to about how Crocs could be a very valid setup in the interim from a financial point of view, from a fundamental point of view, I want to highlight how this can be a good risk to reward trade. And I'm saying from a point of view of an investor in equity, not necessarily in options. You can trade options if you want, whatever. But this viewpoint is strictly from a stock equity standpoint. Now, again, my long is from 77, so your calculation may be a little different. But off of my long at 77.92, this currently offers a 2.5 to 1 risk to reward ratio, where I'm risking just below. I have a stop set at 72.99, so that's below that 52-week low. That's me risking about 6% downside to my second price target here at 90.64 for a 16% upside. Now, again, this is equity. It could keep going, right? I could just hold on and wait. But that is the first point where I'd want to say, okay, maybe I realize gains, move a stop up, whatever. That's the very first point where I reassess how things look on the chart. Are we getting a confirmed bullish reversal? What is actually happening here? So that's the first place I'm going to look. Now, after highlighting that, I do want to give you guys the levels to look at here. Obviously, we're in this big gap here, but if you do consider a long on Crocs, these are the levels you're going to want to watch. 89.92. That's right around my first price target. I'm sorry, my second price target here. My first one was right here at 81.69. You can also use 81.69 as a new level to long potentially. If we close above that, that could be an area where you consider a long position, as it shows the bulls are potentially trying to build some strength above and into that earnings gap. Second price target here is at 89.92. Third is 96. Followed by 99.12, and you fill the earnings gap up here at 102.51. At this point in time on the daily, if it can crack and stay above and officially fill the gap, you will be above all EMAs and MAs on the daily chart. And I believe on the weekly, you'll be probably pretty close on the weekly as well. So that's going to be a key area of resistance there, which is why I said I believe Crocs can go to $100 here relatively in the short term, where I got in. Now, above that, if we see follow through above and through this earnings gap fill to the upside, well, that opens up the door for a few more levels to the upside. Next area you're going to want to watch here is 109.64, and then you push into another potential gap here. Once you pass over 117.76, you break into another gap here of 135.35, which I believe it's not your all-time high, but that's the point where I'm going to look to reassess. Again, tighten up longs again, get really tight here because this is where the air gets much thinner up here. But again, even at that evaluation, you got a nice move here from 80 bucks. What is that? 20, 50, 60 bucks to the upside here. Pretty solid. Let's move up our risk to reward doodad here. Go all the way up to here. If we tap that area, and it's pretty close. That makes it almost a 12-to-1 risk to reward. I'm risking, and again, this is from my personal entry, so yours may differ, but I'm risking 6% downside for 75% upside on equity, which is fantastic. And again, it depends on your patience, depends on your strategy, but that's why I wanted to highlight Crocs as a potential long investment, not just because Sydney Sweeney is wearing some of their shoes, but because of their fundamentals and because of the risk to reward this is currently presenting on the daily, on the weekly, and on the monthly. What do you guys think about Crocs?